Welcome to Origins, the podcast that dives deep into the business of venture capital, where we learn how the people behind the capital, both GPs and LPs, make decisions. I'm Beezer Clarkson, your LP co-host from Sapphire Partners, where we invest in exceptional early-stage venture capital managers ranging the spectrum from emerging to established franchise VCs. And today we've got something a little different for you. As I was going through the Origins archives, I found myself back at one of my favorite episodes from late 2023, with a masterful guest who shared so many great insights that have held true. In this episode, Nick and I speak to David Clark, the CIO of VenCap International, who has built a long history of backing established and franchise VCs across the US, Europe, China, and India. What I love about this conversation is both his point of view on strategy for picking which managers he wants to work with, and the wealth of data he brings to bear on investing in venture. If you follow him on X, you're already familiar with how data-backed his threads are, and that he's not afraid to offer a contradictory opinion. David has been studying the venture ecosystem meticulously for nearly 30 years, and has become incredibly astute at assessing which investing philosophies do and don't work. And nowhere is that more evident than at the end, where we ask him to predict what's coming next. And unsurprisingly, his predictions for 2024 and beyond were right on the money. David is one of the many LPs now leveraging podcasts to share their point of view. While the world of LPs has historically been pretty quiet, we're seeing that if you want to hear their voice, you'll find it on podcasts. OpenLP from Sapphire Partners is now home to more than 150 LP-focused podcast episodes. If you want to dig in, head to openlp.vc, where you can filter for podcasts and the LP perspective. So what can we learn from our conversation with David? Time to find out. David, welcome to the Origins podcast. We're really thrilled to have you join us. You've been doing a wonderful sharing on X, formerly known as Twitter, on your LP portfolio, what you're thinking and seeing, your perspective on what it takes to return a fund, how you've developed your LP strategy around it. Your work as an LP is one I've always admired. I've greatly appreciated the opportunity to become your friend and to co-invest with you. And we're really excited to unpack all of this today on Origins.
Yeah, thank you so much for the invitation. I know we've had some great conversations previously, both Beezer and Nick in it. So it's really nice to actually get one on the record. So hopefully we can live up to what we've been chatting about previously. A quick bit of background on VenCap. So we were founded in 1987, and basically all we do is invest in venture funds. Over the last 36 years, I guess it is now, we've made over 400 commitments, and our strategy has definitely evolved over that period. Like a lot of other LPs, we started off, thinking we could go and choose managers, and we did that for 20 years and then realized that we weren't actually very good at it. And so at that stage, and this is the kind of like late 2000s, we really took a step back and did quite a lot of analysis on the underlying investments that we'd made, the funds that we backed. And one of the things we found was that there was a relatively small number of managers that were consistently able to outperform. And the rest of the managers were actually producing pretty disappointing performance. So I look at all the investments we kind of made up to the mid 2000s, and the majority of funds we backed were doing less than 2x. And as a whole, the program was okay, but it wasn't fantastic. And so we thought there's got to be a better way to do venture. And that's when we really started to dive into the data. And I think that's been the real foundation of everything we've done on the VC side since the mid 2000s.
Well, I'm just going to say, for anyone who doesn't follow you on X, they really should, because you've been so thoughtful in sharing information from your portfolio, and there's such a lack of it in the general venture ecosystem. And I really love the fact that you push back on a lot of the narratives with data. You shared back earlier in August and September some of the performance data, because we had been talking about power laws and just how critical it is to venture. And I think people give lip service to it, but your numbers really grounded it in the reality. Can you unpack that a little bit?
When we look at the underlying data from those 400 plus VC funds that we've backed and got underlying data on something like 16,000 portfolio companies, there were a few things that really stood out. The first one is that more than 50% of VC investments actually don't return capital. And we've seen that consistently over a 30-year period. One of the other things we found was there was a relatively small number of companies that were ultimately responsible for the vast majority of the returns that were generated, both by our funds and by the industry overall. So when we look at the industry numbers, what we find is that 25 to 30 companies each year are responsible for over half of the total exit value that is generated by the VC industry globally. That was a real kind of stark realization for us, that it's not about trying to manage your loss ratios in venture. It's about, can you consistently access those top 1% companies, those 25 to 30 companies that exit each year, that ultimately drive the performance of the entire industry.
So Nick, get ready for this, because I want to, as part of the conversation David and I have been having for a number of years now off screen, is exactly this. Like, do you have to be in these companies, and is it somewhat driven by the size of your fund? Because obviously the bigger your fund, the bigger the outcomes that you need. But if you are a smaller fund, can you do it with a smaller exit? And that also sort of leads in a little bit on the emerging manager world and the differences. Right. And so what I was going to ask you, David, is when you look at this data, will you then characterize the majority of your portfolio as established managers?
I would say that since the mid 2000s, virtually everything we have done has been with established managers. So the earliest that we would tend to intercept a manager would be Fund 3, but I think the vast majority of what we've done have been later than that. And while we invest in early stage, we would characterize early stage as Series A, not seed. Some of our managers have seed programs, but predominantly I would say they're investing at Series A and beyond. And they're doing it out of funds that are, multiple hundreds of millions of dollars. I can count on the fingers of one hand the number of sub $100 million funds that we've invested in over the last 10 to 15 years. So it's a bit of a narrative violation compared to what, we hear from a lot of LPs, in that, small funds outperform, emerging managers outperform. That's not what we found. We found that actually, if you want to get consistently strong performance, the best way to do it is to back those managers that have a proven ability to invest regularly in those top 1% companies. And that's what we've looked to do. And as a result, our portfolio is very heavily concentrated on probably a dozen managers. And while we don't like to publicly disclose the names of the individual managers you back, if you were to ask anybody who were the 25 to 30 best established and most successful VC groups out there, then our core portfolio you would pretty much pick up all of the managers that we back out of those.
I think one of the challenges is just trying to understand in venture, like what the benchmarks are and what the actually underlying data is. So I think David's data set is a really great look into what established manager performance looks like over the last, 20, 25 years. And it's an amazing data set. I think it's hard to filter through as a GP what the right benchmarks and data sets are. Is it Cambridge Associates? Is it some other data set? At PitchBook, it's hard to know what the right benchmarks are as a starting place. I can speak to our experience at Notation, which is probably somewhat generalizable to many emerging managers. So sub $100 million funds. We're on our third Notation fund. Our game is different, I think, than probably larger established manager funds. We don't feel like we need to be in the top 1% of companies or the top, the $10 billion company that happens every year or two or whatever. Our fund sizes are very small, few $100 million outcome returns our fund. So we're just playing a fundamentally different game. In our experience, the math is compelling for very small funds that are not requiring huge outcomes to do very well. Our loss ratio math is probably similar, actually. Maybe that was not the case in 2020 and 2021, which was an anomaly, but we'd expect half or more of our companies to ultimately return $0. Our top few can be multiple turns of a fund at $1 billion or less outcome.
Beezer, you had some data on manager graduation to sort of Fund 3 and Fund 4, so it'd be great to sort of explore that a little bit. But I totally get your point, Nick, around, I do think smaller funds will outperform. And you look at the Cambridge analysis and a higher proportion of the very best performing funds are going to be from emerging managers and are going to be relatively small funds because of the math. I totally accept that. So, I would expect the very best emerging managers and the very best small funds to outperform our portfolio of established managers. The challenge, I think, comes in terms of predictability. And this is more from an LP perspective. It's how easy is it to identify who are going to be the best performing new managers? And that's where we tried to do that over the first 20 years of VenCap, and we failed miserably. And so I guess the question I would have is, it may well be that other LPs are much better positioned to be able to do that. And it may just be something that's, that we're not very good at. And I think it's really important that LPs understand what they can and can't do. The challenge I would throw out there is, do we see a data set anywhere that shows that LPs are actually able to consistently predict which of those emerging managers are going to do well? Because it's one thing throwing out saying, I invested in a 10x fund, in a 20x fund. But what we need to see is, what does that program look like over the course of an entire cycle on an aggregate basis? And when I look at our core manager data, then, from mature core manager funds, and we're talking, significant number of funds here, we're generating returns on an aggregate basis in the kind of 3.5 to 4x multiples. And this is going back over the last sort of 25 to 30 years. So it would be great if anybody knows of a data set, a similar data set for emerging managers, which is actually based on decisions that LPs have made. I would love to see that.
So some of the performance data that David was referencing that we have shared publicly is that there is a very high breakage rate between funds 1 and funds 2, which is not surprising because so many fund 1s are sort of trial runs and people are piloting businesses. Think of it more like a startup loss ratio. So we're not surprised there's about a 50% loss ratio, which really means I think most LPs, and I think this is true from an institutional perspective, do not engage until a fund 2 because a fund 1 might be sub 10 million. It's very hard to get an institutional level check into that. To David's point on persistence, you want to see how the people sort of decide if they want to be an investor or not. And while the news is full of folks who launch much bigger or more established first-time funds, the reality is that's just not what the normal is for a first-time fund. So it's probably more fund 2 or fund 3 when the data set would start being material. This dovetails into, there always have obviously been first-time managers because every great fund that Davidson's had to start out as a first-time fund. We've just seen there's been different times in the life cycle of venture where there've been many more born, right? So there were a lot born in like 98, 99, not a surprise. And then it kind of levels out because in downturns it goes down and then it follows the same rate that you would expect. So you see a lot more in the last 5-6 years. And there's just insufficient time for that performance to have matriculated out. So the data set is just wonky. And then if you also want to look at performance based on, we tend to look at both TVPI and DPI because we think both metrics are relevant. And this is a conversation I was having with David before and a little bit with Nick, was the exits are also really lumpy, right? And so if you want to see performance, you have to have been in some of those upmarket years. And then if you want to have DPI, you're going to have exited. And we just went through a window. So if you didn't exit in 19 through 21, you're holding on now for another, I don't know, I'm making this up, 2 to 5 to 6 years, which means all those funds that have to have performance, I'm sorry, this is a long-winded answer, had to have had portfolios that were in a sufficient point of maturity to then exit in 2019, which means they're really 2010, 11, 12, 13 vintage, potentially earlier. And they just weren't, the emerging manager world was just wildly different back then. So this is a long-winded answer of, I wish there was that clean data set. I think we will have a lot more of it in the next 15 years than we have today.
I think that's really important is to see how a strategy works across an entire cycle. Because I think it's really important. A lot of LPs have only come into the VC industry over the last 10 years. You get a distorted view of what venture looks like if you've only seen the market going up. I think we're in the middle of clearly a correction. It feels like we've seen some of that, but it feels like there's also more to come. And so I think, you have to be able to look at your strategy and the results from your strategy across that longer period. Both are you able to capture the gains as the market rises, but also is your strategy sufficiently resilient that you don't give all those gains back when the inevitable correction comes? So I think that's, again, one of the challenges for perhaps that emerging manager data set is that we've only got half of the story so far.
I'll add a couple other things that I was just thinking on as I was listening to you guys. chat. The first thing is just, we're also not talking about dollar sizes. Notation 1 and 2, I'm pretty sure will end up somewhere in a 5 to 10x range. TBD on where that lands, and they're multiple times returned already in relatively short time periods. Small dollar sizes. So from an LP perspective, for Sapphire, for example, I can speak to Sapphire. Like, I'm not sure notation 1 and 2 will like truly move the needle even at those returns. And so I think that's one perspective. Obviously, established, David, for you're able to invest a lot more dollars. The other thing I was thinking on was, if I were to put my LP hat on for a second, if I were to magically transform into Beezer or David, I think all I would be thinking about for the emerging folks, the 1, 2s, and 3s funds, is, are they committed to this for a very long period of time? Like that, maybe that's the only thing that matters, because presumably folks will learn the longer they're doing it. They'll get more data, they'll be better. And so in my view, maybe the only thing that matters when evaluating a fund 1 or a fund 2 is just, are these people committed to doing this for 10 or 15 or 20 years?
Want me to jump in on this, as we have an emerging manager program, which you obviously know, Nick, and it's been a pleasure working with you over these years. So we do have an emerging manager program, and we have always had emerging managers as part of our portfolio strategy since day one. And we also do established managers. And I just want to underscore what David said. As an LP, you need to know what business you're in, because to do different kinds of investing, we believe, and maybe other people believe differently, you have to have the team, you have to have the time, you have to have a lot of attributes to go after whatever segment of the world you're going after. But you need to know what game you're playing. And if you're playing a game that doesn't work for how you're set up, it's just very challenging. And when we launched our business over a decade ago, to David's point, you could clearly see who some of the OGs of the venture world were, but they potentially were in David's portfolio from 30 years ago. And that wasn't, we weren't alive then. And so the world was, how do you work with the established managers, to David's point, looking at the fund 3s and the fund 4s, like the newly established, and look for the signs of great potential future? And how do you figure out who the next great ones are when the people in the emerging manager world come? And I do think very much around what you were saying, Nick, on understanding people's intentions when they start a fund. And I'm about to say something which is potentially hypocritical, but I think the world has capacity for great funds, maybe not firms, but individual funds to work where people do 1 or 2 and then stop. But I think the GP has to be very conscious of this, because what an LP is listening for is, how serious are you about this business? And maybe it's serious for 15, 20, 30 years, or maybe it's serious for 1 to 3 cycles. The more the GP knows who they are, the LP will resonate with it. And we've certainly had this conversation with managers who might not want to do it forever. And I think that's a very honest conversation to have, because I think a lot of times LPs really worry that what's happening is a GP says they want to do it. They don't honestly know if they really mean that, because how do you know until you start? And then they get locked in and they don't really want to keep doing it, because it is I'm going to speak on your behalf, Nick, but it is a hard business, right? I was just speaking with a GP who has a sort of interesting scout program, isn't the right word, but they work with a bunch of other GPs in sort of smaller individual businesses, looking out for how they might matriculate into becoming more of an established GP themselves. And they were talking about the need to be able to grind it out and to be commercial. And they meant both those words very positively. It wasn't a negative. It speaks to running a financial services business on behalf of people like David, and getting through the tough years like today versus the super fun, easier years when everything was up and to the right. And that is my long-winded answer of saying, I actually think it's possible for there to be great funds without somebody doing it forever. But I think LPs are listening for why you're doing it and how you're doing it. And many LPs are not going to want that in their program. So it's not normative, I would say, but I do think we see it, at least. We see people do 1 or 2 very strong funds and then stop, because that's not what they want to do forever.
Can I just jump in with a question there, Beezer? Because I'm interested. One of the things we really like about established managers are the groups that handle succession well, but keep some of those older partners still within the firm to help mentor some of the junior people that are coming through, but give those junior people room. And we think it's particularly important because it feels to us venture is an apprenticeship business. To some extent, investing and choosing which company to back is perhaps one of the easier parts to it. There's a significant skill set around portfolio construction, reserves management, and I think you only begin to understand the importance of that over time. So I guess a question both to you, Beezer, and to you, Nick, is how much of that weighs on your decision making as you're thinking about, either investing in these newer managers, and for you, Nick, how much of your time is sort of spent around portfolio construction and more sort of firm management questions rather than, is this a great company?
We spend a lot of time thinking about this. I 100% agree with you. And there's definitely some firms that we work with where you see the, maybe not older in years, but the elder and experienced statesperson helping some of the younger folks, because there's a lot to the business that's not just picking the next great company, but there's a lot of times when we see people be able to pick the next great company because they haven't actually been in the business that long. So there's a lot of like, why can't it be true? Versus, oh, we've seen this not work a million times. And it's this interesting mismatch of the two that can produce some real brilliance. I don't think necessarily, though, it's a prerequisite for emerging managers to have it. Candidly, we see some emerging managers where they staple on some experienced folks, and it feels a little bit like the experienced folks are not potentially helping someone, but not providing the hardest part of the advice. And so it's actually a detractor. Do you know what I mean? And Nick, you launched a fund without anyone playing that role.
For years. I mean, I was at BetaWorks where we were making investments, but it was not structured like a venture capital firm. And for years, I thought I had sort of done myself a disservice by not going and working at a more traditional venture firm first before starting Notation. I now think that there's another way. So there's no one way. I think the forcing function for me and for us was we have to figure this out, like for our survival. So we have to figure out portfolio construction and how to think about pro rata and reserves and tax and fund auditing and firm building, or we're just going to die. If you care deeply about the craft and you care about building a business and having a career in this for a decade or two, you're going to force yourself to go find the answers and surround yourself with really amazing mentors and LPs like Beezer that can sort of help you along the way. I think that worked for us. And it was just a literally like life and death matter of going and figuring out those questions. But I also think that looking back in hindsight, if I had worked at a more traditional firm and learned some of those lessons, I would have maybe been slightly better prepared going in.
Can I layer in on this? One of the observations I've been having, and I feel a bit like I've just rediscovered that the wheel is round. So I'm going to share my vulnerability on this one. When I look through now in the market, especially in the emerging managers, when we do our own sort of post-mortem of what's worked and what hasn't, there's really something very powerful about investors, LPs like yourself and GPs like Nick, that really think from a first principle standpoint. And that term gets thrown around a lot. And I kind of hate it, because what I think it really means is people who think exactly like Nick does and David, you do, which is, what does this mean and why am I here? And what's important about this investment and how does it work? And really think for themselves versus, we all have to learn somewhere. So I appreciate there's some parroting back what we hear from the universe, but really take a sort of, here's how I'm thinking about this and here's why I'm thinking about it. And when I peel back the onion on a lot of our emerging managers that have both been persistent in wanting to do the craft and strong in doing the craft, there's a huge trend line around that. And it can take multiple different forms. You don't always hear it in the same language, but it's very consistently there. And you see it in the annual meetings, you see it in how they talk about portfolio companies. I hear the LPs asking different questions. And I think there's something very true about that.
I would just add one more thing, is that a lot of the questions around venture strategy and portfolio construction are a lot easier when you invest in good companies. So like, I think sometimes you can get lost in the strategy and you have to sort of bring yourself back and just say, actually, the job number 1, 2, 3 priority is go find good companies to invest in and be good partners to those founders. When you look back at the data, the 25 years, what are some of the attributes of your top performing firms and managers? You have this amazing data set. And I think you mentioned sometime 10, 15 years ago, there's some underperformers, there's some overperformers. You leaned into the overperformers. And then I'm also curious, maybe just if you were to put on your emerging manager LP hat, I know that's not common for you. If you could maybe begin to spot some of those attributes with younger firms and younger managers, or maybe that leads you to maybe track those firms closer as they do emerge into kind of fund 3, fund 4, fund 5.
The single most important thing that we discovered when we really looked, so we did an analysis of all of the funds that had generated 3x net returns back to us. Basically, we found for early stage funds, around 90% of those funds had at least one company that returned the entire fund. 90, yeah. Yeah. And many of them actually had 2 or more companies that returned the fund. So I think this idea of, it's going back to the first principles. VC is a power law industry. We know it's a small number of companies that ultimately generate the bulk of the performance. And that's true at the fund level as well. So what can we think of as a proxy for what a fund returning company looks like? And how do we use that to sort of screen for managers is basically what we're looking at. So we just did something fairly recently where we looked at, who are the most consistent backers of companies that are worth $2.5 billion. And unsurprisingly, it's the typical, list of suspects. It's the likes of Accel, Sequoia, Andreessen, Lightspeed, Matrix, Hongshan, which is Sequoia China, Index, Tiger, Founders Fund, NEA, Kleiner Perkins, General Catalyst, SoftBank. It's the names that you would expect. The thing that we would then look to layer on top of that is it's great that you can back these highly successful top 1% companies, but you have to do it in a way that moves the needle at the fund level. And I think this is where I would entirely agree with what you were saying earlier, Nick, about the size of outcomes you need. We look at what do we have to believe, given the size of fund that we're investing in, to believe that that manager can generate a fund returner from its strategy. And as fund sizes get larger, then that clearly becomes more challenging. I think what we've seen over the last few years is that the size of the technology opportunity within venture is also getting bigger. Every company is now a technology company. And so I think there's going to be multiple companies that reach the sort of scale that we've seen over the last few years going forward. So, do we want to have to underwrite a $50 billion exit to be a fund returner? Well, we're willing to do that in some instances where we've got conviction that the manager's been able to do that before. We can look into their portfolio to see if they've got other companies that are on that trajectory. But if we're having to make that assumption for a manager that's only ever had $1 billion exit and maybe has only ever returned $150 million back to an individual partnership, then that makes it much more challenging. So I think, understanding what that exit size and the relationship between the exit size, ownership, and fund size is really important. And I'm happy to admit that I think a lot of the more established managers have probably scaled too quickly in recent years. But I look at what's been happening with emerging managers and they've been doing the same. It's just an order of magnitude different. It's, one or more additional zeros on the fund. So I think the venture industry as a whole has been guilty of that. I'm hopeful that over the next few years, we can see fund sizes generally start to rationalize as people realize there's not an infinite amount of capital that can go into these companies. I think finding those fund returning outcomes is the most important thing that we look for. And I think the best gauge that we found is whether a manager is capable of doing that is have they done it before? And so that's why the earliest we would really look to intercept a manager would be fund 3, because hopefully by then, there would be enough evidence out of fund 1 that they have 1 or 2 of those companies that are a long way down that trajectory. Now, that assumes sort of normal 3-year investment periods. If they're putting it to work in 18 months, it's probably going to be fund 5 rather than fund 3. But I think a lot of the things that I hear LPs talk about on podcasts such as yours about wanting to find managers with an edge in a particular area, I'm rather skeptical that actually correlates to successfully being able to predict performance.
I was going to ask you how you look at fund 3 over the last 4 or 5 years, given the TVPI escalation we've seen, and now we're seeing a deceleration. But you answered that question by, it sounds like you're going to wait longer. But how are you seeing the performance? This is like another long-standing meme question in venture, which is specialists versus generalists, and how do you get an edge? And is the edge in your portfolio? What would you say the edge is of your unicorn hunters?
when I look at our managers, it comes down to, 3 or 4 key attributes. You've got to see the deals. You've got to recognize them when you see them. You've got to be able to win them. You've got to be able to ideally add value. Then you've got to be able to understand how to get out of them. Those seem to be the 4 or 5 key elements. What we're hearing from our managers is that most people will see most things at the Series A. So actually seeing a deal isn't the challenge. It's being able to recognize that it's perhaps one of these top 1% companies with world-class founders. And then it's about how do you win that? And I think one of the things, again, we consistently hear is that your chances of winning those super competitive deals increase the more that you have companies in your portfolio that you can use to reference back to those founders. So if I'm a VC and I've backed Facebook and Square and WhatsApp and companies like that, I can use the founders of those companies as my reference. And that's incredibly powerful when it comes to helping those managers win. And I think one of the other things that they're able to do as well is to lend credibility to startups. So if you have an Axel or an Andreessen or Sequoia backing you, and you're trying to hire a head of sales or a head of engineering, then I think that's incredibly powerful as part of the narrative that you're selling to that potential hire. So I think being able to lend that brand to the companies that they back is also highly significant and in a powerful way that they can really add value to those businesses. And then I think that the last thing I would touch on is just having been through the whole cycle with these top 1% companies previously, so that they really understand when to lean in, when to be aggressive, and when actually just to back off a little bit and not chase valuations. I think being able to have that pattern recognition from years of experience, not necessarily within individual partners, but within the partnership as a whole, is really helpful. So I think they would be when I'm thinking about what does that edge look like, it's not necessarily an edge in recognizing or seeing something that nobody else is seeing. It's more about being ultra competitive in those highly competitive situations.
When you talked about building an LP program, right? And you're looking at fund 3s or fund 4s that have earlier in their career, be it whatever the fund vintage is, found some of these successful companies. One of the questions I have is, if that data is out there and you can see it and I can see it and Nick can see it, how do you then as an LP build a business around knowing that you can get into those funds? Because it's a bit like what you were saying about the Series A. And so how do you make that magic happen? Because clearly you have, which congratulations. It's not easy is what I'm thinking, right? From a general perspective in the market.
It takes time. And you have to make sure that you're sizing your program accordingly. Even though we're one of the longest established fund of funds out there, we're quite a distance away from being one of the largest fund of funds out there. And that's deliberate. We don't just want to scale our business. We don't want to be the largest investor in VC funds. We want to be the best investor in VC funds. And we think there is a limit to how quickly you can scale that business, because I do think, once you get outside of whether you want to call it the sort of top 25, the top 30 managers, then I think it's a very different risk return profile that you're looking at there. And again, our experience is that you're adding additional risk for no additional return. So I think for us, we want to keep our portfolio very focused, and it means that we only need to add 1 or 2 names every 3 or 4 years. If I look back at what we've added over the last few years, there's probably been only 1 addition to our core manager portfolio. And that was partly because we thought it was impossible to differentiate managers over the last 5 years because everyone was doing fantastically well. We had no idea who was actually really generating alpha and who was simply capturing beta. So we kind of made a very conscious decision that we weren't going to go and chase managers at that stage. And actually, when we look back at what we did post-financial crisis, there were 3 or 4 of our existing managers that we intercepted for the first time in 2009, 2010, 2011, because that was a time where a lot of their existing investors were struggling with the lack of liquidity. They were over allocated to venture. They had to pare back on their allocations. So I think there's an opportunity perhaps over the next few years where that story repeats itself. So actually, whereas we've been leaning back a little bit and leaning out over the last 5 years, it feels like we want to lean in over the next couple of vintages. And so there are a couple of names that we have on our portfolio that we'll spend a lot of time talking to and getting to know and building a relationship. And we'll share a lot of the data that we have with them. And, we'll hopefully, really build a rapport and so they can understand that we're long-term investors here. And, we do see things over decades rather than, 2 or 3 year cycles, but we'll pick our time to intercept. And I think, one of the things I've said to you previously is we don't have to do every great fund out there. We just have to make sure every fund we do is great. And that's really, I think, the fundamental basis of how we see the venture industry.
I love that quote.
It's a good one. That applies to GPs too. We don't have to do every company, but every company has to be great. So
correct. Although I was thinking about it, the pitch book data that you were tweeting, David, shows I wasn't saying the loss ratio for LPs is different from the loss ratio of a GP, but given the amount of really not even 1x DPI out there, maybe that's actually not true.
I'd love someone to recreate those numbers because I look at it and I was very surprised by it. So if anyone has got access to PitchBook and would like to run those, it would be great to get some confirmation that I haven't messed up on the analysis there. But yeah, what we found. So we looked at all the venture funds globally that had return data on PitchBook that were raised between 2000 and 2015. So there were just under 1,200 venture funds in that sample. And it was something like more than 50% of them hadn't returned 1x DPI. And so these are funds that are at least 8-9 years old, and in some instances a lot older than that. And I was actually quite shocked by, how poor those DPI numbers were. And the flip side of that was there were just under 6% of them that had returned 3x DPI. And so I think when LPs are thinking about, establishing a venture program, I know some of the conversations we've had with some LPs previously, we've been a little bit surprised by their return expectations from venture. It'd be great to hear, how you guys think of that. I mean, when you were starting Notation, Nick, what were you saying to prospective LPs about what your return expectations were for the fund? And similar, Beezer, how are you thinking about it with, the programs that you guys are running?
I personally prefer it when folks give both TVPI and DPI because, to your point, David, I'm constantly flabbergasted at how little DPI there is when people talk about numbers, and what most of the time people are talking about is TVPI. But that, especially what we're seeing right now over the last 18 months, and who knows where the world will go, but it's not feeling like the exit market is opening back up anytime soon. We're seeing a lot of folks that had 3, 5, 8x TVPI coming back down to 1.5 to 2. And I think there's going to be a lot of that happening. So if you haven't converted it, I don't know how to weight the chance of converting. Hence my point of I like TVPI and DPI because you do want to know people doing that. And so we've, for better or for worse, always built a program that believed DPI mattered. And so we do look for managers that also have that sensibility. It doesn't mean to say you can force an exit. It doesn't mean to say that exits will happen in certain timeframes, right? We're in the midst of looking at a bunch of fund extensions right now because everyone needs another couple of years to hang on for the next exit market. But it does mean we always have that lens with how we look. And I don't know if many GPs I don't know if all GPs, I should say this accurately, look at it with that same lens. I think the world has been very, and for good reason, very receptive to TVPI only. I just think at the end of the day, even for people with sort of infinite time frames, at some point they need that money back from somewhere in their portfolio. And if it's not coming from venture, it will eventually get squeezed. That's my long-winded answer, Nick. Why don't you give a better one?
I think for really early stage funds like ours, return expectations are a sort of a bizarre concept. It's almost like talking about the outcome rather than the process. The way I think about it is we have a very simple fund model, and we just think about what is the total enterprise value of the portfolio need to be, and what is our average ownership of that enterprise value need to be to produce a 5x plus fund, which is our goal. We're trying to model in a realistic expectation around the total enterprise value of the portfolio and a realistic expectation of what we own of that portfolio to produce a reasonable outcome. But the reality is you're 5 or 10 years later and you look back and everything is different than the model. It's almost like a pre-seed company making a financial model for what their business is going to look like 5-10 years later. So it's obviously different and unexpected. I have a slightly different question for David, which is I was listening to you talk about your own fund math and your kind of constraints around scaling. How do you as a firm, I mean, you've been doing this a very long time. How do you as a firm avoid strategy drift? Because I'm thinking about all the other things that you could be doing. Like, let's build a seed program, and that seed program could lead to our sort of established manager program. And then we have relationships, and we are already in the funds that maybe will graduate to our established manager program, or maybe we should do a crypto fund. Like, there's so many other things around your core that you could be doing. I appreciate the focus. And so I'm just curious, as a firm and as a team, how you avoid all of the inevitable distractions.
There's a few things that kind of go into that. I was at an LP meeting a few weeks ago, and they put a quote up by Steve Jobs, and it was basically along the lines of, focus isn't about the things you do, it's about the things you don't do. That's what we want to make sure we're doing. We're not getting distracted by all of these things that look interesting and that could be great. We want to really continue to double down on the stuff that we know we can do well, and we have the data that shows that we can generate, strong and consistent performance, through that strategy. And I think there's a few things that are driving that focus. One is the fact that I kind of earned my venture stripes in the late 90s through the dot-com boom and bust. And we made all the mistakes you could possibly imagine during that time. So we scaled our funds up in the late 90s. We broadened the number of managers we backed. Everybody was doing great. We thought, if we're backing a manager whose last fund was 100% IRR, then, it's only a matter of time before the next one's 100% IRR. For a while, we were the smartest people out there. And then the market turned and we were the dumbest. So if you kind of, I can pull my sleeve up and you can see the scar tissue that I have from that period, which is, venture is hard. There's only a fairly small number of managers that ultimately can generate outperformance, and you need to be focused on those managers that are able to do that consistently. So I think that's part of it, and a very strong part of it. But we also have to think that commercially, we're a fund of funds. We have to go out and raise capital from third parties as well. And so we need to have a value proposition that stands out in the market. There are lots of other fund of funds that have the same access to managers that we have. We're not any better at getting access, but we have, nearly 90% of our capital has gone to, a dozen managers over the last decade. What we do have is that real focus. And I think that's what differentiates us in the marketplace when we look at other fund of funds. We're focused on those dozen managers. And whereas, some of our competitors would have 30, 40, 50 managers in their portfolio. And I think ultimately that's driven by capital under management and chasing AUM. And it goes back to what I was saying earlier about, we don't want to be the biggest, we just want to be the best. And we think that's the way that's going to allow us to do that over time.
I love it.
I'm very curious to hear both your perspectives on what the go forward looks like next year and maybe beyond. We've been through a rough patch here the last 12, 18 months. You guys sit, I guess, in some similar parts of the ecosystem and also different. So just curious to hear different views on where we are and what the next year or two looks like.
I think I'd mentioned earlier that it feels like we're a little bit in the kind of the calm period before the next leg down. So, we clearly saw a correction in the venture market, mainly around the later stage valuations that were driven by the changes in the public markets. What I don't think we've really seen yet is the bulk of companies that raised capital in 21 at the top of the market come back to raise new rounds. What we're hearing is a lot of those companies have done a really good job in extending their runway, in reducing burn and getting closer to profitability. I was just on a call with one of our managers yesterday, and they were saying that I think it was something like 3/4 of their companies have 2 years of runway or more. I think people understand the playbook of what you do in a downturn. But I do think that's just delaying the day of reckoning. It feels like there are still too many private companies that were funded over the last few years. One of the things we track, as I mentioned earlier, is what percent of companies are valued at less than 1x. Historically, it's been more than 50%. since 2013, it's been more like 30%. So I do think we're going to see some reversion to the mean on that. And I think we're starting to see that happen now, but it could take another 24 months until it's fully played out. Obviously, what happens in the capital markets between then and now is probably going to have an impact on how severe that second leg down is. But I definitely think we're going to see a lot of companies fail to raise any more capital and ultimately either have to find a home or go out of business. I do think we'll see some companies that are able to raise new rounds, but the valuations will be significantly lower than we saw in 21, even with the growth they've had over the last couple of years. I think one of the things I'm a little bit concerned about is that, you know, we will see companies survive, but they'll no longer be growth businesses because they've had to cut away a lot of that growth just in order to eke their cash out for longer. So I think that the challenge for businesses is you need to be valued by the public markets ultimately as a growth company, not as a value business. And so how, you know, they've made a good transition from growth to, you know, growth at all costs to growth at a reasonable price. You know, can you lean into that growth phase again if you do have a little bit more capital available? I do think we've got another leg down, but I think the good news is we will start to see, you know, that there's still a lot of companies we see in our underlying portfolio that continue to post good metrics, that are very strong businesses that have been able to take advantage of this downturn to really improve their competitive position. So it feels like when the public markets eventually do reopen, there's a fairly strong pipeline of companies that could tap in there. The question is what does that valuation look like? From a new return, a new investment perspective, I'm actually feeling much more excited about the prospects we're seeing for new capital deployment today than I have done for quite some time, because there are, you know, fewer funds out there raising capital, less capital being invested, fewer companies, you know, being started. And I think, you know, I think it was Chris Duvos who said that venture works best when time is plentiful and capital is scarce. And I very much buy into that.
And what's your prognosis for all of the funds coming back to market in 2024? We're hearing there's quite a few that and have done the similar math that the companies have done, which is let's wait and try to give 2023 a wide berth and manage it out, but maybe come back in 2024. What's your sense amongst your LP peers about the receptivity to that?
I think it's really going to depend on the individual managers. I think you have to have some credit in the bank with your LPs. And it'll be very difficult if you raised your fund one in 21 and there's really nothing to show and now are looking to raise fund two. I think they're going to be some really challenging conversations. Particularly if your LP base are also newer entrants into the asset class, because I think a lot of the people that came in for the first time at the top of the market are probably going to be the first ones to leave. I think fundraising for the newer managers could be particularly challenging if you don't have credit in the bank with your LPs. And as you said earlier, Beezer, you had been able to take advantage of the strong exit markets to put some points on the board and return some capital. So I think it'll be challenging. I think for some of the more established managers, there's no real issue there. You know, most of the managers that we back, that you may see a little bit of turnover in their LP base. You may see them come back with slightly smaller funds as they've rationalized fund size. It may take a little bit longer to raise the capital, but I don't think there's a question about whether they will raise funds.
Nick, what's your experience on the ground with startups? Is this 2024 reckoning feel reasonable, or are we cynical?
We've seen some of this in our portfolio, but also just reading the tea leaves from announcements, I do agree with David that you're starting to see the insane unicorn batch from 2021 start to sort of hit reality. So just in the last couple of weeks, I think Convoy shut down pretty quickly, and there were a couple other announcements. And I agree that I think we're just at the beginning of that, of these like billion or multi-billion-dollar companies just almost overnight, at least from afar. I mean, I don't know the inner workings of some of these, but just from overnight, like we're shutting down operations in 2 weeks. There's no buyer. That's it. I do think we've unfortunately seen a couple of those in our own portfolio as well. So I do think we're in the early innings.
I agree with everything you two have said. The other additional color I'd add is that anecdotally, but I've read this in some surveys that other folks have put out, that I think from a denominator aspect, I'm speaking from an LP perspective, there was a lot of denominator challenge, 12, 18 months ago. And I feel like that's worked its way through the system. So I don't what I hear from my peer set, I don't hear as much of, oh, we're not doing more venture because of the denominator. What I hear is exactly this. We think it's still going to be rocky over the next year because while people have cut their burn, that doesn't mean their product market fit is as established as they thought it was, possibly because they're selling to other startups that are having some constraint, possibly because if they're selling it to more established companies, startups or otherwise, the budgets are not like, yeah, do whatever you want. It's like, no, you have, like, budgets are getting squashed. So all of that is working its way through. And then you do see these big blowups in companies, which is inevitable. But if it's all getting delayed, LPs, the most rational response from an LP is to say, let me wait and see if there's a question about this because of the whole entire whatever's going on in the firm versus a let me re-up right now and give me more time to see how these things get weathered. And I think the managers that are getting that question the most tend to be newer managers, funds 1 through 4, right? To David's point, if you've been doing this for 15 years and you have a history of DPI and TVPI and managing succession and new partners, and you have a real connection with your LPs, I just think people have a lot more conviction around it. And I agree with everything David said, so I won't repeat it. But I do think for everybody else, 2024 is going to be a lot of reckoning and coming to terms with that. And I think for a lot of GPs, it's understanding how to engage with LPs in a way that's both authentic and talking about bad news without freaking everybody out, to put a commercial term on it. But it's fair, right? As an LP, I'd much rather hear, hey, I'm concerned. And we're hearing this from some of our GPs, like, this vintage is challenged. And it goes back to 2019. Like, it's not just the 2021 vintage. And we appreciate that. I mean, I would just say as a plug, like, we would much rather hear what your concerns are and why you're concerned, and the companies that might look good on paper, but have some structural issues, than to not hear it and then be asked to re-underwrite it and not know what's going on. So that's my plug for the, like, transparency is great. I appreciate all LPs might not respond that way, but we'd much rather hear it.
One of the things we would look for is for our GPs to get ahead of the curve in terms of making sure they're valuing their companies realistically. And I know there can be a challenge around reducing valuations, particularly if you're about to embark on a fundraising process. But I think getting those write-downs in sooner rather than later actually gives you credibility among LPs that really understand what the market looks like. If we saw a manager that was holding everything at last round value from 2021, then that's telling us an awful lot about, how transparent that manager is likely to be, and perhaps what he thinks of their LPs as well.
I have one last maybe comment, but also question, because I have less historical context than both of you, and I wasn't around during the .com. Well, I was alive, but I wasn't VC.
You're making me feel old.
And which is it just this is the portion where I make myself feel a little better. It feels like venture and the technology industry broadly is also just in a very different place than it was compared to the .com or even the financial crisis. Like, my perception is that in the .com, there was broad questions around venture as an entire asset class. Is this a viable asset class? And it feels like today there is much broader institutional acceptance of this as an asset class and a part of a portfolio. And similar to what you said, David, at the very beginning, it feels like technology is now a much more accepted part of society, broadly speaking. It's in every company. And so even if this is a little bit of a rough patch, it feels like sort of the base that's been built in the technology business and the venture business is much, much higher than it has been in previous downturns. That's my perception. I'm curious what you guys think about that, and maybe through some historical context in previous downturns.
As someone who started their venture career right on the eve of the 2000 collapse, I would definitely say wildly different from I'm not sure if people didn't believe venture as an asset class didn't work. They thought it felt more of a cottage industry, to use a overused term. I think there was significant question on whether or not the internet mattered, right? And so David and I have talked about this. There was the fund that I was in, I say this all the time so people know that it happens, gave back their money to the LPs, literally closed down. Other funds just gave back a lot of their money and became significantly smaller because they felt the opportunity set wasn't out there. But it didn't mean the venture as an asset class wasn't going to be true. And I don't think today people question it at all in the same way. I do think, and I'm going to hand this over to David, is that I am seeing LPs that run a book of business that includes venture and private equity. This is more the foundation endowment model where they can do a wider range. Consider how much venture exposure they really want in the long term, not getting out of it, but maybe it's getting trimmed versus some of the FOMO we saw in 19 and 20 where people were really piling in. I'm seeing folks just sort of, I would say, haircut. I don't know, David, how does that land for you?
Yeah, I think you're right. And I think partly that's due to the increase in interest rates, because I think as interest rates go up, it has a greater impact on long duration asset classes. And I know talking to some of our investors who run a strategic asset allocation model, that is a factor around what sort of allocation numbers it spits out for things like venture and other long duration assets. So I do think that's a part of it. But I kind of still come back to the fact that it feels like every company now has to be a technology company, and even specifically every company is probably going to have to be an AI company as well in some elements. It's interesting in Europe because I think you guys in the US have a much better understanding of how strategically important technology is from an investment perspective. I still think we're fighting that battle to some extent in Europe. I absolutely believe that having a significant exposure to technology is the only way that you're going to generate substantial growth in a portfolio. And whether it's through emerging managers or established managers, that you can fight that battle and figure out what works best for you. But I think you have to have significant exposure to these companies, because ultimately, that's what's going to be driving the growth in the economy long term.
And you can see that in the public markets too.
100%.
I've been looking at all that data. The top 7 technology companies have basically produced all of the returns in the S&P over the last, whatever it is, 2, 3, 4, 5 years. Yeah. So you see that at a much larger scale too.
We're going to wrap it up.
Fun. Okay.
David, thank you so much. We're going to put all of your tweet threads in the podcast notes so folks can find you on X and read more as you write more and enjoy it as much as we did.
Cool.
Thank you so much.
I've really enjoyed it. Thank you.
Thanks for listening to Origins. You can learn more about what David and VenCap are up to these days at vencap.com, and we'll have a link in the show notes. And if you're hungry for more venture insights like these, be sure to subscribe to the monthly OpenLP newsletter, where we curate a short list of the month's most thoughtful venture content from top GPs and LPs. You can do this at subscribe.openlp.vc. We'll be back with a new episode next month. Thank you for listening.